Nvidia earnings out, that's in the rearview mirror, but couldn't save the market from a down day overall. We've had some surprisingly hot data over the last 2 days, and that just leads to the conclusion that the Fed may actually have to stay higher for longer. What's your first blush impression of the week?
Well, there's a lot there, but thanks for having me on. First of all, yeah, Nvidia drives Mag 7. Mag 7 drives the market. So that earnings release was important. And of course, they blew it through the water. That stock's up well over 200% for the year, 2,500% for 5 years. And if there's been a weak spot in the market, it's been big tech over the last 20 years. Now, used to, when I would look at it, I'm a fundamental investor. I'd see Amazon with a 5 or 6% margin, didn't make money. I couldn't understand the valuation. And arguably, I've missed the boat early on. But with Nvidia, it's easy to look at that from a value standpoint. The company's got 50% margin. They're running 90+% return on equity. They're growing like crazy. Their position in the market is not only super a first mover advantage in the AI space and accelerated computing, but it's already getting entrenched. And so it's a really amazing stock. But I would say the market's got a little more depth to it than just Nvidia or Mag 7, because if you look around at all the companies reporting in the first quarter, these companies, we had earnings surprise here, right? We did well up over 5%, 5.3% in earnings expectations when the market was expecting, 3.9%. And so that was a nice boost to help some of this downside protection everybody's worried about amidst some other concerns about rate hikes, higher for longer, inflation and stuff, which we can talk about.
Dory, I want to dig a little bit in on NVIDIA and the Mag 7 specifically here for just a second, because I feel like the big question is, after the numbers, should people be thinking about adding to NVIDIA if they don't have a position, or if they don't have a large position, should they just stay pat? And does that extend to the rest of the Mag 7 as well?
Well, that's probably the biggest question for not only individuals, but institutional investors, right? If you're an index person or you're a large cap manager, do you have the Mag 7 allocation to your portfolio? Do you have the Nvidia allocation? So about a year ago, I started saying, you under-allocate at your own risk, because these stocks have fundamental reasons to keep growing and to keep driving the market and to keep what? Dominating the S&P. So if you under-allocate, you're in big trouble. I think that still holds. Nvidia still looks strong. Microsoft still looks strong. And if you want to outperform the market, then you can tactically overweight some of these stocks that you like more and underweight the Teslas and the whatnot. But you under-allocate Mag 7 at your own risk. So you kind of have to be in, and you have to bite the bullet. And I would get this same question back in November and December when the stock was $300 or $400, and I said, you just have to close your eyes and put a little in, and then pray that there's a dip of 10 or 20% to shake out some of the euphoria, and you can get in then. But I think you got to establish a position and then pray for some dips. The joke I had with my trader was, I said, hey, you're supposed to be buying this Nvidia on dips. This was a few months ago, and he goes, there haven't been any dips. And I said, no, Rick, the dip is when it only goes up 1%.
I like that. You're right, though. The U.S., it's more than just U.S. tech here. And I know that you're also looking at financials, some of the banks. Just tell us maybe some individual names that you like and why you might be favoring the sector overall.
Yeah, so other areas besides big tech, obviously, where else can we participate? In the first quarter, financials and energy did real well. I think fundamentals on energy, just as a sector, still look really good for long-term infrastructure issues, et cetera. Being in oil and gas can be very profitable. Back on the banking sector, the market has taken this position, and then we can get back and talk about the Fed, but the market has taken a position that the banks can't do well unless rates go lower. And that is just not true. Banks can do very well where rates are right now. Now, they're not used to having rates hiked 500 basis points, and that creates some net interest margin pressure, but it's short term. Unless you do something silly and stupid like long-term assets with short-term liabilities, and that got shaken out with some bigger banks in March of 2023. But most banks don't do that. Most of them lend on the short term, borrow on the short term, adjust their margins, and they're fine. The other thing that's already priced into banks, so we've priced in, oh no, higher for longer, so that's bad, which is not true. But what may be true is this factor of, hey, what about credit issues, particularly office space? And everyone's looking for the problems. They're in office space, but they can't figure out who has it. Smaller banks say bigger banks say smaller. They both say regional says CDOs. It's sprinkled in all of them, okay? So you have to do your work on the credit side. But I'll tell you this, it's overpriced to the downside on the fear factor for banks. And there are many banks that have very little office space exposure and actually expanding margins.
Well, Dory,
right now that are screaming buys at lower prices than they were in 2009.
Well, Dory, I want to talk about a couple of them, because when you talk about the market sentiment towards banks, the market sentiment towards large banks seems to be okay, particularly like if you look at the JP Morgan, which is up 18% this year. It's really sort of the mid-sized, the regional banks that have gotten smacked in particular, right? The two banks that you like are, in fact, regional banks. One of them is called Enterprise Financial. It's based in St. Louis and Kansas City. The other, right there at home in Texas, Texas Capital Bank shares. So what stands out about those two, both of whom have underperformed the market this year?
So let's talk about the difference right quick. People have always found safety in bigger banks. Oh, JP Morgan, they're too big to fail, we'll buy them. But that's not for upside. And with the reports we're seeing out right now that deposit costs are getting more and more expensive for the bigger banks, whereas before they had a competitive advantage. And so some of that is actually really good for these community banks. Some of them have a better control on their deposit costs than others. In addition to, most people would be surprised to know that JP Morgan has 6.4% tangible capital. Personally, I'd like to see about 8%. Well, these two banks you just mentioned are running at 9 and 10% tangible capital. So if things get ugly, this is actually a competitive advantage because a bank with large capital amounts, they can go grow in a down market. They get to define the credit terms. They get to pick up the banks on the cheap when they're buying. They can do all kinds of things. The regulators give them a green light because of that capital. So there's this perception that big is bigger, is better, but it's only bigger. And in some cases, they actually have more risk on the balance sheet. I'm not saying JP Morgan is risky. I'm just saying I wouldn't like to see as much leverage in JP Morgan or B of A or in Citi as I do some of these community banks, which are run with a much safer capital level percentage.
Dory, it's always good to catch up with you and get some investing ideas from you. Have a great weekend.
Thank you.